Hi, everybody. So welcome back to this panel discussion. I have the pleasure of having Jeff from SGX, Gerald from 𝗵𝘆𝘀, and 𝗪𝘆𝘀 from iFAST Research. So we'll talk about just three main themes in terms of the investment outlook for this year that investors can focus on. Yeah, so the first topic is really on inflation. I think a lot of investors have been hearing about inflation a lot in the last couple of years. So related to that, of course, is rising interest rates, but also the demand and popularity of your risk-free assets like your treasury bills. So the question I would have is for Gerald, because Gerald manages 𝗵𝘆𝘀, so it's an investment content portal. There's a lot of information and content and advice that he has there from himself and collaborators on the outlook for things like T-bills. So I thought it would be good to bring Gerald in. So I think we have this slide in one of our research presentations. So I think a lot of people expect inflation to be tamed very fast and to go back to normal as if, the last 2 years is just a bit of a short nightmare. But our view at iFAST is that it's not going to go back to normal, lower rates of inflation so fast. And I think we have this slide just showing that it takes a number of years, in fact, for a number of countries to go back to a more normalized 2% inflation kind of rate. So do you think this inflation is going to continue, I guess, for this year, Gerald? And also, what does it mean for investors on the outlook for Singapore Treasury bills?
Okay, hi everyone. Thanks so much for coming today. I think for inflation, it is very closely linked to how the market actually performs in 2024. But if I take one step further and not just look at inflation, I think at the back of everyone's mind is really what is the interest rate outlook. And this is something that will effectively determine how different asset classes will actually perform in 2024. Okay, so I actually run a weekly webinar series and I actually update what are the investor expectations on interest rates on a weekly basis. And it is very interesting for me to see that the expectations have actually shifted a lot over the past 2 months. When I was updating the charts, say in November last year, the expectation was that we'll only see the first rate cut coming through in the second half of this year, and that there will be probably a maximum of 3 rate cuts at the end of this year. But at the start of this year, when I'm updating the charts once again, I think the picture is something that is very different, okay? So investors are actually expecting that the first rate cut will come through in March this year. So that's actually in 2 months' time. And then at the same time, there will be 6 rate cuts in 2024. So if you've been following the US market very closely, if you've been following T-bills very closely, if you have been following Singapore savings bonds very closely, that's effectively what has shaped the direction over the past 2 months. We have seen US stocks actually going to close to their all-time highs. We have seen the interest rates on the Singapore savings bonds and the treasury bills coming down over the past 2 months. So the question is whether we'll really see 6 rate cuts in 2024. Okay, so the question is what will happen if we don't actually have the 6 rate cuts coming through this year? Will the equity markets remain elevated? Will we actually see some of these bond instruments coming back into favor again? So I think the key message at the end of the day, going back to treasury bills, is it is important to have, once again, a diversified portfolio, because even if you're 100% invested in treasury bills, there's always the risk that you will have the reinvestment risk when your T-bills actually mature. So as we have already seen over the past 6 months, if you were invested in T-bills, say 6 months ago, you might be able to get a yield of above 4%. For the latest auction, we are looking at a yield of about 3.74%. So we don't really know what the yield would be 6 months down the road. So I think it is really up to us to be able to diversify our portfolios so that we don't face a situation where 6 months down the road, our only investment choice might be a T-bill that is giving us a yield that is lower than what it is today.
Yeah, thanks, Gerald. I think also, for investors who are a bit unsure about whether that would affect the cut-off yield of the treasury bills in the next few months, one other option could be to go for a more flexible cash management solution where you have the flexibility of just buying in and selling out quite fast So you don't have to think about being stuck, let's say, in the product for 6 months or more. So that's one option for you to consider, like the auto sweep at FSMOne. I'll bring Jeff in because Jeff, as many of you are familiar with, he's the face of the Singapore equity market in terms of advice. Yeah, I think going into this year, what's your outlook for Singapore? What are the sectors that you like more and maybe dislike? Yeah, Jeff?
I guess first and foremost, everything hinges on these less tight financial conditions. So as Gerald said, market expectations are for up to 150 basis points in cuts this year across the 8 Federal Reserve Market Committee meetings. But if you read into some of what the more hawkish side of the Fed, it could be 3 cuts, 75 basis points cuts. So that's not in glue just yet. And when you look at the Fed Reserve FOMC composition this year as well, you've got, it's slightly more dovish, but one of those dovish governors, Tom Barkin this week, was even suggesting it might be too early for a March rate cut, which the markets have priced in. So when you're coming to this juncture of cuts, it's always going to be a bit jumpy, okay? So that's looking at it from a trading perspective. But from an investing perspective, the outlook for this year in Singapore is definitely much more brighter. So last year we grew our economy at about 1%, and the STI was also comparatively flat, as was Southeast Asia growing at 5%. But this year, when you're looking at corporate profitability, as I said, it hinges on those less tight financial conditions this year. As Gerald was looking at the revisions for the interest rates, the economists here were forecasting that corporate profitability would be higher in December when they last surveyed the professional forecasters than they thought in September. In fact, in September, our local economists were even Steven between whether corporate profitability be higher, flat or lower this year. And then in December, it was revised upwards to 57% expectations. So that's a 24 percentage point increase in their expectations for higher corporate profitability this year. And what does that hinge on? Higher growth. Singapore's growth rate more than doubling into the 2% range. We are a trade-centered nation, just as we are a financial hub and a company that also, you could say, is a hub for investing in funds. Very much an extension of what we do offer here in Singapore as a financial hub. We've got global trade expecting to triple up to 3%. So for manufacturing, electrical and components, the mega themes of sustainability, all those mega themes that were discussed in the previous Capital Group presentation really are embedded in our outlook for the stock market this year, okay? So interest rates, if they remain status quo, don't change, you expect to see more optimization in a lot of the companies, trying to get more out of less. And then if we do have the better growth outlook and a more cheery, brighter outlook, then you're going to be looking at those sectors that have been more affected and downridden by the cyclical challenges of the last couple of years, like REITs and so forth.
Yeah, thanks, Jeff. I think on REITs, we'll cover that in a while. I'll just bring Wei-Ren in first. Because I think, Wei-Ren, I think in your presentation earlier today, you were talking about recession, the dreaded word. But actually, even if, let's say, that materializes, even though I think some experts are saying that the recession risk for the US has gone down, right? Because it seems like the economy is actually sturdier than expected. But anyway, let's assume if it happens, actually what kind of impact do you think it will have on the stock markets? That's one question for Singapore and US. And perhaps for investors' knowledge, do you think that there are actually more important risks or dangers that can harm the outlook this year?
Okay, on the topic of recession, I think our basis is actually not for a full-blown recession to happen in the US, because I think the economy in general is still very resilient. Consumers are spending, government is also spending, and the budget deficit in the US is currently at a scale that is seen only in war times. So if you have a government that is spending freely, you have consumers who are still having good jobs, it is actually very difficult for us to sort of rationalize a scenario where the US will undergo a deep recession. So our expectation is actually for the US to continue instead of a rolling recession where certain sectors are not doing well and certain sectors will come in to help pick up the slack that's left behind by these weaknesses. For Singapore, we are actually quite positive on the outlook. We don't think a recession is coming. And just to add on to what Jeff has already shared about Singapore, I think Singapore is one of the beneficiaries of this shifting geopolitics between US and China. And the troubles in Hong Kong, the troubles with Credit Suisse in Switzerland has also elevated Singapore to be the place of choice for wealth management and also the financial hub for many investors. So Singapore is also benefiting from the troubles of other financial hubs. And I think very importantly, Singapore is export driven. So if you agree with us that there's going to be a semiconductor rebound in the year ahead, then again, Singapore is going to be one of the major beneficiaries of this rebound. So implication for investors, I think please keep faith in the Singapore equity market. I think it probably will do well this year. If you're looking for opportunities to capture that semiconductor opportunity, perhaps the Straits Times Index, the ETF probably wouldn't be a good thing to invest in. So if you want to capture that semiconductor rebound, it would definitely have to be buying the individual stocks of the companies, the SGX listed semiconductor companies like AEM, UMS. So I think these companies are going to be the key beneficiaries of this semiconductor rebound.
Yep. Okay. Jeff, you want to add to that?
No, I was just going to come in and add about 10 names to that. I won't be cheeky.
Okay.
There's also a second question on the risk, right? For outlook for investing.
Yes, on the REITs.
Okay.
I wanted to ask, because I think we've been quite cautious at iFAST on the outlook for Singapore REITs for well over a year. Jeff, what's your sense in terms of what investors should be doing? Because it's been a tough year, right, in the rising interest rate environment.
Yeah, investors have continued to buy REITs. In fact, retail investors, when you look at broadly in our stock market, since the end of 2019, so for those 4 years of challenges, we had net retail buying at about 14 billion Singapore dollars. That's not total, that's net. And what we noticed was that if you look at it and trying to deduce some revealed preferences from the average retail investor in Singapore, they definitely like to buy more at lower prices and take that value trading type of methodology into trading. So back in 2022, when we outperformed the world very strongly, we saw our least buying. And then we saw the most buying, obviously, in 2020 when we did lag the world. So what we're seeing for the REITs is continued buying last year, albeit more cautiously, and investors being more selective. Obviously, everything does hinge on those tighter financial conditions. We saw that in the month of December. Our S-REIT index had its strongest performance ever since inception. We've had that index. And then you had the second best, or maybe the third best performing in the month before. So you had a very big, strong repricing. You've got that as a major hinge factor because it impacts so many things for the REITs when you have higher interest rates. It obviously impacts your financing costs, which cuts into your net income, which cuts into your DPU. Higher interest rates also affect your tenants and therefore the ability to have rental rates up higher. But as Gerald has done a lot of work with his weekly newsletter, there's been a lot of kind of pockets of strength within the REIT sector that have been really interesting, particularly those involved in data centers and cloud services and AI. REITs that have been able to increase their DPUs, see positive rental reversions, and then of course you've got REITs of all different spectrums. If you are concerned about the higher interest rates, you've got REITs with lower gearing ratios like Paragon, Asaso REIT, Fraser Logistics Commercial Trust, and so forth. So, looking at the Singapore REITs, I think for iFAST investors, they've probably got a little bit of an edge because you have so many products to screen through. And you're used to going through and filtering and working out, doing a little bit more homework, getting to know the actual segments in a little bit more depth. And I think you need to take that methodology into investing in our REIT market. Because there's been a lot of trading opportunities in the REITs as well, not just looking at REITs from a buy and hold and receive the yield, etc.
Thanks, Jeff. And Gerald, on S-REITs, or maybe just generally on income-generating assets and investments, what's your advice for investors?
Okay, I think Jeff mentioned a very good point around the performance of the REITs in December. How many of you here are REIT investors? Just show so I am a REIT investor as well. So I also noticed that the REITs did very well in December. But what was very interesting to me is that even after the best month since inception, it is actually not even back to the levels in September last year. So I'm sure as a REIT investor, when you check and update your portfolio, that is something that is very evident to you. In that while we have seen a bit of a rebound, actually we are still a very long way from where we were even back at the start of 2023. So I think that is effectively where the opportunity arises. But as we have seen in terms of the interest rate outlook for next year, it is still uncertain because it can range from 3 rate cuts all the way to 6 rate cuts. So I think that is where we still need to be selective in terms of the REITs that we hold, because different REITs will be impacted by the interest rate environment in a different way. I think if you have looked at the performance of the REITs in 2023, it is very evident. The best REIT in 2023 was actually up 20%. That is one of the data center REIT that Jeff mentioned earlier, Digital Core REIT. But if you look at the worst performing REIT, it was actually down close to 60%. So you actually have a very wide range of outcomes, even if you are a REIT investor. But once again, like what Jeff said, you have a range of different products that you can invest in. If you feel that you do not have the ability to pick out single REITs, then there are REIT ETFs as well that you can effectively get exposure to the entire REIT sector without having to choose the individual REIT for yourself.
And the next 5 weeks are going to be so much fun because we have 25 of the REITs reporting their full year results. And this is when the research analysts, which used to be at Credit Suisse, really come to work. At the moment, if you look at the unit prices on the Friday close, they're around 20% lower than all their existing 12-month, 18-month target prices. And then at the same time, they're trading at around 20% lower than their 5-year book value, price-to-book ratios and so forth. So as Gerald said, markets, even though we've had those big moves in December, November, market is still has an element of caution in the outlook.
Wei Ren, you want to add to this discussion on the REITs, but?
I think investors should really be extremely selective when it comes to S-REITs. And I think a big part of that is because of our outlook on Fed policy and interest rates. So I think if you were there for my presentation just now, I think you will know that our base case is actually for the Fed to hold interest rates in 2024. So I think this sounds like heresy to many of you because now the Fed themselves, they've already said they're going to cut rates. And like what Gerald said just now, markets are pricing in 6 rate cuts. But I think that's where the risk is because when the consensus is so overwhelmingly tilted to one side, then there's very little room for error. So if inflation suddenly picks up in 2024, then this rate cut narrative could shift very suddenly, could reverse. And if inflation picks up even more, then I think we may be staring down the possibility that we could be facing rate hikes in 2024 instead. So if this narrative shifts, then I think a lot of REITs are going to be hit. And if you're a REIT investor, then I think essentially you want to be in the better REITs within the sector. So I'm for being more selective when it comes to REIT investing rather than just going for a broad-based ETF approach.
Thanks, Wei Ren. One question on China for Wei Ren. So, because I do know that some of our investors do have exposure to China, despite our more cautious view, but just wanted to maybe wrap up on this China point. What's one catalyst perhaps you think you want to see for the outlook for China to be positive?
I think one thing that we would like to see is actually for valuations to go down. So I think distressed assets can still be attractive if the price is right. So I think if the valuations of China's equity market goes down to the point where we think perhaps the risk in the Chinese equity market is it's priced in. So I think that is where we will consider turning a bit more positive on Chinese equities. But I think a caveat here is that even though we can potentially turn positive if markets decline, we will unlikely be turning super bullish on Chinese equities in the foreseeable future. And the reason for that really is because of the confidence crisis that is facing China right now. It is not a problem that can be solved easily. Confidence takes time to recover. And until we see confidence coming back in to property market, into consumer spending habits, I think it's very unlikely we will turn very positive on China in a big way.
Yeah, thanks, Warren. So we're still pretty cautious on the outlook for China. So I think, yeah, for those of you who still have exposure, that's maybe a takeaway in terms of how you want to adjust the allocation in your portfolio. So we'll wrap up because we're holding you back from lunch and first lucky draw of the day as well. So just to wrap up, what's the biggest fitness investment strategy that you have for investors in 2024? It can be a strategy, it can be a stock idea, it can be an investment idea. Let's start with Jeff.
Just align with the big economic themes: digitalization, sustainability, artificial intelligence, generative AI. All these themes have stocks represented in our stock market. We have a number of products that are also important. One thing we didn't discuss for the outlook is the geopolitical concerns, which, as Hui-Ren said, there is that risk of higher inflation. Geopolitical concerns, if there's an escalation, can cause it. Gold has been a staple over the last 5 years, generating something like 60% return for those investors that do want to kind of manage some exposure for the geopolitical perspective. Sustainability has been really important for us in Singapore. Our two stocks that have seen significant pivots to sustainability, Keppel and Sembcorp, both generated symmetrical 60% total returns last year. Sembcorp at the moment has around 13 gigawatts of renewable projects under capacity and development. For Keppel, it's closer to 4 gigawatts. How much is a gigawatt? 1 gigawatt can power around 270,000 HDPs in 1 year. So lots of these little economic themes that are super relevant. Great time to be in the markets and do your homework because the markets are there for what you are looking for. You just got to find the right one.
Okay, thank you. And Gerald?
So as an investor, I always like to look for turning points because I think that effectively will be where the opportunities actually lie in. And for me, looking at the 2024 and the year ahead, I think the two turning points that we're effectively looking at, the first one we have discussed very extensively during the panel today, which is around interest rates and what kind of opportunities that actually present. Of which maybe we might be wanting to have selective REITs, but we need to be careful because they'll be impacted in different ways. The second one that we briefly mentioned, but did not have the opportunity to go into detail, is really around manufacturing, exports. I think if you look at the economic data over the past 1 or 2 months, we have started to see Singapore's exports starting to increase again after 12 consecutive months of decline. So I think that is effectively another opportunity to be considering, given that the valuation of some of these stocks that are linked to manufacturing and exports are quite depressed as well.
Yeah. Thanks, Gerald. And Hui-Ren?
I'll answer this question with my best investment idea for this year. I think my answer will probably disappoint Jeff, but it's not Singapore. My best investment idea is actually Japan. So on the point about turning point, I think Japan's economy is at a turning point. I think inflation, wage growth, I think this is going to be sustained, and Japan has a golden opportunity to break free from its deflationary cycle. Number two, the Japanese yen, deeply undervalued. So in the event that Japan's equity market doesn't do well in 2024, you could still potentially get returns, currency gains from a Japanese yen appreciation. Number three, also, I think Japan is also one of the beneficiaries of, the geopolitics, because I think Japan is very good in advanced manufacturing, and with countries stuck between the two superpowers of US and China, they are all turning to Japan. Japan is still the third largest country, economy in the world, and they are all turning to Japan as a source of capital and as a source of technology as well. So Japan will stand to benefit from this also.
Yeah, Jeff, you want to add?
Yeah, 31st of January, SGX is listing a new ETF, AI-powered, focused on the Japan market. One more thing, lots of research analyst notes out throughout the year. They don't just work over the next four weeks. They're working all throughout the year, so please do use them as well. Thank you.
Yeah, okay, thank you very much to my panelists, Jeff, Gerald, Wei-Ren. I hope you have taken away some insights. And that's it for the panel. Stay with us. Remember to put your lucky draw slip in the lucky draw box, please. It's coming back here at 1:10. Yeah, so thank you very much. Bye-bye.